Welcome to Trading Nation. Let's talk about something not a lot of others are talking about. High yield debt, often seen as a proxy for equities. The HYG, the biggest of the ETFs related to high yield, may be exhibiting a sign some people call affectionately the death cross. Craig Johnson of Piper Jaffray, Larry McDonald of the Bear Traps Report. Craig, what is the death cross and what do we care about?
Well, Brian, the death cross in a technical term is really where you get your 50-day moving average crossing back below a 200-day moving average. And when we've done some back testing on this typical scenario, a lot of the damage is done before the cross actually takes place. I'd probably say 75% of the damage from what we have found. But that is just a common term to discuss 50-day crossing back below this. Now, when you look at this and put it in terms of the high yield index itself, you can see that that phenomenon is happening right now. You can also see from the chart we provided that you're getting a divergence right now between the S&P 500 and high yield. In the past, that has signaled that perhaps there is a challenge ahead with the market. There is a concern something might be wrong. And what we look at on the HYG right now is 70% of all of the maturities of what's in the HYG is between about a 1 and a 7 year duration. So cranking up the shorter end rates from the Fed right now is leading to a weak and rolling over pattern in the HYG that's leading to some people to come to a conclusion that there's a problem in the market. We would disagree with that when you start digging into this at this point in time.
Larry McDonald, what would you say about high yield? I mean, not technicals aside, are you worried about this market? It's huge.
Well, the biggest thing going on is we've had a big move in energy. So the default rate in high yield has improved because energy, oil is up from mid-20s in 2016 to close to $65 now. So that's helping high yield. But if you look at the real driver in the last 12 months, it's been the European Central Bank. They were doing, $2 trillion of economic stimulus and what's called buybacks, asset purchases. And they've been buying some really poor quality assets, companies like Steinhoff. And some of these, they're really being embarrassed. So we think that there's pressure on the ECB, not just because of economic activity today. It's very clear that the ECB's buying program isn't going to be as long as people thought going forward. And that's a humongous driver because they're creating moral hazard in the world. They're buying so many high yield bonds in Europe that's driving down yields here this year. But if the ECB pulls back, that's a very, very big negative for U.S. high yield. We think that's the biggest risk in the next 6 months.
Steinhoff, never has a South African retailer gotten so much attention recently in the U.S. bond market because it's kind of seen as a symbolic. We are watching the HYG, something a lot of people need to watch. Craig and Larry, we appreciate your insight as always. And folks, we always appreciate you tuning in to Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.